Hey, happy Monday, options traders, and I hope everybody had a fabulous weekend. And last week we were talking about, it's really a three-part series on different aspects of condors, iron condors, gut iron condors. And while I was putting those together, it made me think of another related topic, which I've talked about before, but this might be a clearer way to see it. And that is that time decay isn't the problem. Everybody talks about time decay and what a big risk it is, and they spend a lot of their time trying to manage their way out of time decay, either by selling options or rolling options or things like that. But is time decay the problem? Well, once you understand, you'll see that it isn't the problem. It's really just an illusion. So let's go find out why. And as always, before we do, please be sure to click like and subscribe. Greatly appreciated and helps so much to promote the channel. So let's take a look at our at the money time decay curve. So here we've got an option worth 10 with 100 days until expiration. And we know that the first 75% of the time that you are going to lose 50% of the value. So as we move from 100 days to expiration down to 25, in other words, 75 days have passed, that option is going to lose 50% of its value. And in the final 25% of the time, you're also going to lose 50%. And this is the scary time decay slope that everybody talks about and says you can't hold your option into, in this case, the final 25 days, because that's when you're going to start going off the steep end of the time decay curve. And they'll say, well, let's roll out with a calendar spread. We talked about that before. It doesn't avoid the time decay. You're just buying a calendar spread, and if the stock stays still, yes, you will profit by the calendar spread, but that doesn't mean that you dodged time decay. And the thing that I want to show is that for any block of time, in this case, if we want to trade in these final 25 days, it's going to cost you a certain price no matter how hard you try to dodge it. So take a look. Remember that at a given volatility, a block of time must cost the same. If it didn't, if one method allowed you to decay slower, there would be an arbitrage. And so the thing that made me think about this as a different way of showing it to you is when we were talking about the in-the-money strangles for the gut iron condor. So take a look at this. Let's look at an out-of-the-money strangle, and that means you're going to buy a call and a put with different strikes, but the same expiration. So for example, maybe you buy the 100 put and buy the 105 call. This is the typical run-of-the-mill strangle. So in this case, we would say you have purchased the 100-105 strangle. And without any additional information, you would assume that the put is on the low side and the call is on the high side. And that's why this setup can expire worthless if the stock closes between the strikes at expiration. However, we can do an in-the-money strangle. And what we're going to do to create this is to switch the strikes to create an in-the-money strangle, technically called a guts strangle. And that means that the call has a lower strike than the put. It's just the opposite. So we might buy the 100 call and buy the 105 put. And when you do, you've created a $5 box. This position is guaranteed to be worth at least $5, the difference in strikes, because you have the right to buy shares at 100 and you've got the right to sell them at 105. So no matter what happens, you could always exercise and pay 100, you could always exercise and sell for 105. So this arrangement, this in-the-money strangle, has to always return at least $5 at expiration. Well, that's different from returning zero when we looked at the out of the money. But do you really benefit from it? Well, take a look. Here's a pricing model, and it doesn't matter. You can pick any numbers that you want. So in this instance, we have the stock at 102.50. I have the $100 strike here in the top, and I've got the 105 strike here on the bottom. So let's take a look at this combination right here, where we are buying the 105 call, that's the high strike call, and buying the $100 put. This is our kind of our standard strangle layout with the put strike on the bottom. And according to these prices, now I have to go out to 4 decimals, otherwise we're going to run into rounding errors, and that's going to cost us a little over $2.60. But we could also create the strangle in the money. And what we're going to do is go off on this diagonal. We're going to buy the 105 put, remember this is the 105 strike, and we're going to buy the 100 call. And so, yes, see it now, it's getting a lot more expensive. It's going to cost you over $7.60. But take a look at those two prices. They're nearly exactly $5 apart. And that's because we have a $5 box here. Now, the reason they're not absolutely identically $5 apart is because we actually have a different call strike, and that's going to change some of the pricing ever so slightly. But remember, in the real world, this is not going to be enough to even discuss. They are trading $5 apart. So here's our out of the money strangle in red. Here's the in the money in green. So notice we have the 100 put on the left. We've got the 105 call on the right. So if we zoom in on it here, there's our 100 put, our 105 call, and the cost that we saw was $2.60 roughly, but that is all extrinsic value. And that means that if the stock closes between 100 and 105, down in this flat area, you are going to lose the full $2.60. But what if we do the in the money strangle version? Let's take a closer look at it. Notice we've switched them. We've got our $100 call on the left and the 105 put on the right. We have a $5 box. And that's why the cost was a little over $7.60, but there's $5 of intrinsic value that's guaranteed to be there at expiration. And therefore, there's $2.60 of extrinsic value. So look at where the bottom of this graph sits. It's at $2.60. It's not at $7.60 like you would suspect. See, what you're doing is paying $5 today to be guaranteed to get $5 back in the future. Well, that's hardly a good deal, not a bad deal, but it's nothing to write home about, as though you've dodged time decay. So notice with the first strangle, you're going to pay about $2.60, and if the stock stays right in the center at 102.50, it expires worthless, and you have lost 100%. And in total, it's $2.60. But you could do this alternative method where we use the in the money strangle. And yes, it's going to cost you more, a little over $7.60, but when it expires, it's going to be worth at least $5. And if the stock is anywhere between these strikes, it will be exactly 5. And so think about it. If you paid $7.60 and it expires worth 5, you've only lost 34.2% instead of 100. And that's where traders say, oh, this is so much better. What a better arrangement than using the out of the money strangle because I only lose 34% instead of 100. Well, it's an illusion because you still lost $2.60, exactly the same amount as you did with the out of the money strangle. And that's because you can't dodge time decay. What you can do is you could put on a different trade or a different format, like we did over here, and it can give you the appearance that you're dodging it, but you're not. The bottom line is if you want to trade in the final X% of the days, you've got to pay for it. You cannot kind of outsmart the market by rolling it or selling against it or doing anything else. You are simply putting on different trades to maybe mitigate that, but you're not dodging it because those could also go against you. So here's another way to look at it. On top, we have the $100 stock with a 100 strike, 30 days to expiration, and 20% volatility. And we see that the call is trading for a little over 228. Down below is the same information, the same inputs, but we're just going to make it 5 days until expiration. And at that point, the call is worth 93 cents. So again, we're getting into this area of that steep part of the time decay curve where traders will say, oh, you can't trade in these final 5 days. You have to avoid this. You need to close your option. Well, all that's saying is that you don't want to trade in these 5 days. And what if the event that you're expecting to happen, in this case the stock going up, happens in this 5-day period? Well, you missed it. You either want to be in the position during this 5-day period or you don't. And if you are trading during that 5-day period, you're going to pay the same amount, even though it might not look like it. So take a look here. Notice that we have 6 times the amount of time if we have a 30-day option versus the 5-day option. We know from our square root pricing rule that we take the square root of 6 is 2.45, and that means that this option up here on top should be 2.45 times higher than this option. And if you take it out in a calculator, you'll see that 0.9338 times 2.45 gives you exactly 2.2872. So the point is that did you dodge time decay by maybe closing the option in these final 5 days? No. You were just avoiding the 5-day period. But you didn't really dodge it. You just got out of the position. That's really the bigger question. Do you want to be in during these 5 days or do you not? You shouldn't let the fear of, oh, I'm about to go off the steep part of that time decay curve, so I need to exit the position. It's more about what's your goal and do you want to trade during this window? And if you do, this is the cost no matter how you tried to avoid it. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.